In the grand theater of corporate finance, there are certain rituals, traditions that are so deeply ingrained they feel like laws of nature. When a company's stock price climbs high enough, the CEO and the board convene, and with an air of triumphant generosity, they announce a stock split. The financial news networks break in with special reports. Analysts applaud the move, citing increased liquidity and accessibility for the small investor. The stock price, almost invariably, ticks up in celebration. It's a move that is seen as a reward for success, a sign of confidence, a shareholder-friendly action. It is one of the most common, most celebrated, and most instinctually accepted practices on all of Wall Street. And Warren Buffett, the most successful investor in human history, believes it is an act of profound foolishness. He doesn't just dislike stock splits. He fundamentally rejects the thinking that leads to them. His life's work, the corporate monument that is Berkshire Hathaway, stands as a defiant, $500 billion testament to this contrarian belief. The price of a single Class A share of his company, a number so large it looks like a typographical error to the uninitiated, is not an accident of history. It is a declaration of principles. It is a filter. It is a carefully constructed message to the world about the difference between the fleeting noise of the market and the enduring creation of value. To understand why Buffett hates this common Wall Street practice is to understand the very core of his philosophy. It is to learn to separate financial engineering from business building. It is to undergo a transformation, moving from the mindset of a speculator who rents stocks to that of a proprietor who owns businesses. This is not a story about a trivial corporate action. This is a story about the nature of value itself and how one man's refusal to play a simple game revealed a deeper truth about how wealth is truly built. It is a journey into the mind of a master, designed to permanently alter the way you look at any company, any stock, and any headline that Wall Street tries to sell you. The entire concept of the stock split is built upon a subtle yet powerful illusion. It's a piece of financial sleight of hand that feels so intuitive, so positive, that few ever stop to question its logic. Imagine a successful local pizzeria, one that you own a piece of. It's a fantastic business, renowned for its quality ingredients and loyal customer base. The business is a single, large pizza. As an owner, you hold a claim on that pizza. Now imagine the manager, in a bid to make ownership seem more accessible, announces a brilliant plan. He takes the pizza, which has always been cut into 8 large slices, and he recuts it into 16 smaller slices. He then sends out a press release, declaring that the pizzeria has made its slices more affordable for everyone. The local news celebrates this pro-patron move. New people, who previously felt an entire large slice was too much to buy, now clamor to get one of the new, smaller, cheaper-looking slices. But you, as an owner, must ask the fundamental question: is there more pizza? Has the manager added more cheese, more pepperoni, or increased the diameter of the pie in any way? The answer, of course, is no. You own the exact same percentage of the exact same pizza as you did before. The only thing that has changed is the unit of accounting. The value of your total holding is identical. This is the simple, unassailable logic that lies at the heart of Warren Buffett's disdain for stock splits. They are a cosmetic change, a recutting of the pizza that does absolutely nothing to enhance the underlying value of the enterprise. To truly grasp the emptiness of this corporate ritual, we must travel back to a time of rampant, unbridled speculation, a time when illusion became reality for millions of investors, right before it all came crashing down. The late 1990s. The dot-com bubble was in full swing, a period of market euphoria so intense it has become the benchmark for financial manias. A new paradigm, it was said, had emerged. The old rules of valuation, things like profits, cash flows, and balance sheets, were relics of a bygone era. The new metrics were eyeballs, stickiness, and burn rate. In this feverish environment, a company called Cisco Systems was a titan. It wasn't a flimsy pets-on-the-internet startup. Cisco made the routers, the switches, the very plumbing of the internet. As the digital revolution exploded, Cisco's business grew at a breathtaking pace, and its stock price followed suit, soaring to unimaginable heights. To the average investor, Cisco was a can't-lose proposition, and its management leaned into the hype with gusto. A key part of their strategy to fuel this public enthusiasm was the frequent use of stock splits. Between 1991 and 2000, Cisco split its stock a staggering 9 times. A single share purchased before this period would have turned into 288 shares by the peak of the bubble. Each split was greeted with breathless commentary and a fresh surge of buying. When the stock would climb to, say, $80, the company would announce a 2-for-1 split. The price would then reset to $40, and a new wave of investors, psychologically anchored to the idea that the stock was now cheap again, would pile in, convinced they were getting a bargain on its inevitable march back to $80 and beyond. In March of 2000, this frenzy reached its apex. Cisco Systems, a company with just over $2 billion in net income, briefly became the most valuable corporation on the planet, with a market capitalization exceeding $500 billion. The stock splits had worked their magic, creating an army of enthusiastic shareholders and a stock chart that looked like a rocket launch. But the pizza had not gotten any bigger. While the number of shares exploded and the nominal price was kept in a psychologically attractive range, the underlying business, while good, could not possibly justify the valuation the market had placed upon it. Warren Buffett, from his quiet office in Omaha, watched this madness unfold. In his 1999 letter to shareholders, written at the very height of the mania, he didn't name Cisco, but he spoke directly to the foolishness of the era. He wrote, "The line separating investment and speculation, which is never bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. Nothing sedates rationality like large doses of effortless money." He cautioned that a wildly optimistic investor in a business reality that was merely good but not miraculous was a recipe for disaster. The stock split was a key ingredient in this recipe. It was the tool used to continually blur that line, to make a wildly expensive speculation feel like an accessible investment. When the bubble burst, the fall was catastrophic. Cisco's stock plummeted more than 80% from its peak. The investors who had bought in, lured by the cheap post-split prices, were decimated. They learned the hard way that a lower share price is not the same as a lower valuation. The pizza, which they thought they were buying at a discount, was still the same size, but its perceived market value had evaporated. The stock split hadn't created any value on the way up, and it offered no protection on the way down. It was, as Buffett understood, pure market noise, a distraction from the only thing that truly matters: the sustainable, long-term earning power of the underlying business. This historical episode serves as the foundational anecdote for our exploration, a stark reminder that corporate actions designed to manipulate perception rather than enhance reality are a dangerous game for the individual investor. At the very core of our reaction to a stock split lies a deep-seated cognitive flaw known as the money illusion. This is the tendency of the human brain to think about currency in nominal terms, the numbers printed on the bills, rather than in real terms, which is what that money can actually buy. We feel richer if our salary goes up by 5%, even if inflation is running at 7%, because the number on our paycheck is bigger. A stock split is the corporate equivalent of this illusion. It presents a lower number, a lower price per share, and our brain interprets this as cheaper or a better deal, completely ignoring the fact that the total value of the company and our stake in it has not changed by a single penny. This plays directly into another powerful psychological principle, the unit bias. Our brains have a peculiar preference for whole units. Given the choice, we would rather have a whole chocolate bar than half of a bar that is twice as large. We feel a greater sense of completeness and satisfaction from owning a larger number of whole units, An investor might feel psychologically better, more substantial, owning 100 shares of a stock at $10 than owning a single share of a stock at $1,000, despite the fact that the financial position is identical. The stock split is a masterclass in exploiting this bias. It takes one expensive-looking unit and transforms it into multiple, more psychologically palatable units. It feels like you're getting more for your money, even though you are getting exactly the same thing. This is not a failure of intelligence. It is a feature of how our brains are wired for efficiency. In most areas of life, associating a lower price with a better bargain is a useful mental shortcut, a heuristic that saves us time and cognitive energy. When you're shopping for groceries, the cheaper can of beans is, in fact, the better deal. But the stock market is a counterintuitive environment where these shortcuts lead us astray. The price of a stock is not like the price of a can of beans. The stock's price is meaningless without the context of the number of shares outstanding and the earnings of the business. The market, however, is a collection of human brains, all susceptible to these same biases. The positive reaction to a stock split is the collective expression of the money illusion and the unit bias on a massive scale. It creates a temporary and entirely artificial surge in demand, driven not by a change in the company's prospects, but by a change in its packaging. Buffett's refusal to split Berkshire stock is a direct rebellion against this psychological manipulation. He is forcing his potential partners to overcome these biases, to do the mental work required to see reality clearly. He is saying, "I will not cater to your cognitive flaws. If you want to own a piece of this business, you must first demonstrate that you understand that the pizza is the same size, no matter how many slices it's cut into." This act of defiance is not just a corporate policy, it's a form of investor education, a lesson in financial discipline written in the language of stock prices. To inoculate ourselves against this powerful psychological pull, we need a practical mental model, a blueprint for thinking that overrides our flawed instincts. Let's call it the pizza slice analogy, a direct and visceral way to translate the theory into a repeatable practice. The moment you hear that a company you own or are considering has announced a stock split, you must immediately engage this three-step process. Step 1 is to visualize. Close your eyes and picture the company not as a ticker symbol on a screen, but as a giant, round pizza sitting on a table. This pizza represents the entire business, its factories, its patents, its brand, its earning power. Your shares represent your slice of that pizza. Step 2 is to reframe the corporate action. The CEO has not baked a new pizza. The board has not discovered a secret recipe to add more toppings. All they have done is taken a knife and cut the existing slices into smaller pieces. A 2-for-1 split means they cut every slice in half. A 3-for-1 split means they cut every slice into thirds. Your total ownership of the entire pizza remains precisely the same. You have simply traded one large slice for two smaller ones. Step 3, and this is the most crucial step, is to ask the only question that matters: has anything about the pizza itself changed? You must become a ruthless interrogator of the business fundamentals. Has this action increased the company's revenue? Has it lowered its costs? Has it expanded its profit margins? Has it strengthened its competitive advantage? Has it reduced its debt? The answer to all of these questions will always be a resounding no. The stock split is an action that occurs entirely outside the business itself. It is a change in the stock market's ledger, not in the company's operations. By forcing yourself through this visualization, you strip the stock split of its psychological power. It is revealed for what it is: a cosmetic change with no bearing on intrinsic value. This mental model then becomes a launchpad for a more disciplined analysis. Instead of getting excited about the lower price, you are prompted to dig into the company's financial statements. You start asking the questions a business owner would ask. What is the return on equity? What is the free cash flow generation? How is management allocating capital? Suddenly, the stock split announcement becomes a non-event, a piece of market noise that you can calmly and confidently ignore, while you focus your attention on the substance of the business. This is how you move from being a price renter to a value owner. It's a simple mental trick, but one that, practiced consistently, builds a powerful wall of rationality against the market's most seductive illusions. To fully appreciate the wisdom of this contrarian stance, we must examine the opposite path, the road traveled by the overwhelming majority of investors and corporate managers. This is the path of the 99%, a path paved with good intentions, conventional wisdom, and disastrous results. For the typical company, the stock price is not just a reflection of value, it's a marketing tool. The executive team, often compensated with stock options, has a vested interest in maintaining a high level of market enthusiasm. When the stock price reaches what they perceive to be a high level, say over $100, a sense of anxiety creeps into the boardroom. They worry that the stock will be seen as too expensive for the average retail investor. They hear from their investment bankers that a split would increase liquidity and broaden the shareholder base. And so they follow the well-worn script. They announce the split. The financial media dutifully reports the news as a positive development. The stock gets a temporary bump. The executives feel they have done something smart and shareholder-friendly. The 99% of investors react just as predictably. They see the headline. They see the lower price, the unit bias kicks in, the money illusion takes hold. They think, this is my chance to get in. They buy the stock not because they have studied the business, but because the split has made it feel accessible and exciting. This creates a dangerous feedback loop. Companies perform the gimmick, and investors reward them for it, which in turn encourages more companies to do the same. This entire ecosystem is focused on the stock's price, not the business's value. It fosters a culture of short-termism. Management starts to think about what will please the market this quarter, rather than what will build enduring value over the next decade. The shareholder base they attract is, by its very nature, less stable. These are not the long-term partners Buffett seeks. They are momentum chasers, hot money traders, who are just as likely to sell on the first sign of bad news as they were to buy on the news of the split. The disastrous consequences of this path become clear during any market downturn. The shareholder base, built on the shaky foundation of stock split hype, evaporates. The stock price, untethered from a core of committed, long-term owners, plummets. The very liquidity that the split was supposed to create becomes a torrent of sell orders. This is the path of treating a stock like a popularity contest, and it inevitably leads to a focus on the superficial over the substantial. It's a path that consumes management's time and attention, diverting it from the hard work of operational excellence and intelligent capital allocation. It is, in essence, a massive, collective distraction from the business of business, a game that Buffett chooses not to play. The ultimate proof that a stock split is a purely cosmetic event lies in the cold, hard numbers of a company's financial statements and valuation metrics. Let's perform a simple but powerful thought experiment. Consider a hypothetical company, American Innovators Corp. It has a thriving business and has earned the market's confidence. Before the split, its financial profile looks like this. The market price per share is $200. The total number of shares outstanding is 10 million. If you multiply these two numbers, you get the company's market capitalization, which is a staggering $2 billion. This is the total value the market places on the entire enterprise. Now, let's say the company earned $100 million in profit last year. To find the earnings per share, or EPS, we divide the total earnings by the number of shares, which gives us $10 per share. A common valuation metric is the price-to-earnings, or PE ratio, which is the stock price divided by the EPS. In this case, it's $200 divided by $10, giving us a PE ratio of 20. Now, the board of American Innovators, following the Wall Street playbook, announces a 2-for-1 stock split. Every shareholder will receive an additional share for each one they currently own. After the split, what does the financial profile look like? The number of shares outstanding has doubled to 20 million. Because the value of the company has not changed, the market price per share is instantly halved, dropping to $100. What is the new market capitalization? It's the new price, $100, multiplied by the new number of shares, 20 million, which equals exactly $2 billion. Nothing has changed. Let's look deeper. The company's total earnings are still $100 million, but now we divide that by 20 million shares. The new earnings per share is $5. And what is the new P/E ratio? It's the new price, $100, divided by the new EPS, $5, which equals exactly 20. Again, nothing has changed. Every single valuation metric that matters, price to sales, price to book value, dividend yield, will be identical before and after the split. An investor who owned 100 shares worth $20,000 before the split now owns 200 shares worth $20,000. Their slice of the economic pie is precisely the same. The financial connection is clear and irrefutable. A stock split creates zero economic value. It is a nullity. Any subsequent rise in the stock price is not due to the split itself, but to the psychological factors we've discussed, the irrational exuberance of a market temporarily fooled by a change in packaging. This mathematical certainty is the bedrock of Buffett's position. He operates in a world of numbers and intrinsic value, and in that world, a stock split is a rounding error, a distraction. By refusing to engage in this pointless exercise, he is making a powerful statement. Berkshire Hathaway is a company focused on creating tangible value, on increasing the size and profitability of the economic pie. The number of slices it is cut into is a trivial detail, unworthy of the attention of a serious long-term business owner. Warren Buffett often speaks of his shareholders not as a faceless group of investors, but as his partners. In his mind, when someone buys a share of Berkshire Hathaway, they are not just buying a stock. They are entering into a multi-decade business partnership with him and Charlie Munger. This deeply held belief that the quality and character of a company's shareholder base is a critical business asset is the philosophical engine behind his refusal to split the stock. He is not trying to attract everyone. In fact, he is actively trying to repel a certain type of person. He wants partners who are in it for the long haul, who understand business fundamentals, and who will not panic and sell at the first sign of trouble. The high price of a Class A Berkshire share is the most effective filter imaginable for cultivating exactly this kind of shareholder. It ensures that the person buying the share has thought long and hard about the decision. It requires patience, discipline, and a significant capital commitment. This process by its very nature weeds out the day traders, the speculators, and the momentum chasers. It selects for people who share his time horizon. This philosophy was put to the test in a fascinating and revealing way in the mid-1990s. The story begins not in Omaha but on Wall Street, where financial product innovators saw an opportunity. Berkshire Hathaway's stock, then trading in the tens of thousands of dollars per share, was a symbol of success, but it was inaccessible to the average investor. A handful of firms began creating products called unit investment trusts. They would buy up shares of Berkshire's Class A stock, place them in a trust, and then sell small, fractional units of that trust to the public. On the surface, it seemed like a noble goal, democratizing access to one of the world's greatest companies. But Buffett saw something more sinister at play. These trusts came with hefty upfront fees and ongoing management expenses. They were, in his view, preying on the desire of small investors to be associated with Berkshire, while siphoning off a significant portion of their potential returns. He saw these operators not as facilitators, but as parasites, using Berkshire's good name to enrich themselves at the expense of the very people he considered his potential partners. In his 1995 shareholder letter, he addressed the issue with his characteristic bluntness. He wrote that these products were designed to be sold, not bought, and that they were being promoted by salespeople whose compensation is directly tied to the volume of their sales. He called out the high costs and warned investors away. But the products continued to proliferate. Buffett realized that his warnings were not enough. He needed to provide a legitimate, low-cost alternative. And so, in 1996, with a palpable sense of reluctance, he announced the creation of Berkshire Hathaway's Class B shares, which would be nicknamed Baby Bs. This was not a stock split in the traditional sense. It was a strategic defensive maneuver. The new B shares were priced at 1/30th the price of an A share and carried proportionally smaller voting rights. In the press release, Buffett was explicit about his motivation. He stated, quote, "As I've said, we don't believe in splitting the stock. What we are doing is creating a Class B stock for the specific purpose of minimizing the chances that our shareholders will be taken advantage of by these unit trusts." He made it clear that if he were buying for himself, he would still choose the A shares, but he wanted to offer a, quote, low-cost alternative for investors who want to be with us. This entire episode is a masterclass in his philosophy. His primary concern was not liquidity or the stock price. It was the quality and well-being of his shareholder partners. He saw a threat to them, and he engineered a specific, targeted solution to neutralize that threat. He was willing to bend his own no-split rule by creating a new class of stock, but only to uphold the deeper principle behind it, to protect and cultivate a shareholder base of informed, long-term co-owners. The baby Bs were not created to attract speculators, but to provide a safe harbor for genuine investors of smaller means, proving that his focus is always, first and foremost, on the integrity of the partnership. This deep-seated desire to cultivate a specific type of shareholder taps into a powerful element of human psychology, our instinct to form tribes and our loyalty to the groups we belong to. The concepts of in-group and out-group bias are fundamental to social psychology. We naturally favor members of our own group, we trust them more, and we are more willing to cooperate with them. Warren Buffett, whether consciously or intuitively, has engineered Berkshire Hathaway's ownership structure to harness this very principle. The in-group he has created is a global tribe of long-term, business-focused investors. The initiation right for joining this tribe, particularly for the Class A shares, is the high price. It's a significant barrier to entry that requires more than just money. It requires a certain mindset. To save up and purchase a single share of Berkshire Hathaway for a price equivalent to a luxury car is a profound statement of belief. It is an act of commitment. This process forges a powerful psychological bond between the shareholder and the company. They are not just holding a ticker symbol, they are a member of an exclusive club, a partner in a legendary enterprise. This creates an incredibly powerful sense of identity loyalty. Berkshire shareholders don't just own the stock, they are Buffett people. They make pilgrimages to Omaha for the annual meeting, which they affectionately call Woodstock for capitalists. They read the annual letters with an almost religious devotion. This is not the typical relationship between a shareholder and a publicly traded corporation. This is a covenant. The practical benefit of this carefully curated in-group is immense. It creates what Buffett calls a, quote, permanent capital base. When the market inevitably panics, as it did in 1987, 2000, and 2008, Berkshire shareholders do not run for the exits. Their identity as long-term partners is stronger than their fear. They trust that Buffett and Munger will navigate the storm and use the chaos as an opportunity. This stability is the bedrock upon which Buffett's entire strategy is built. He can make bold, contrarian investments during crises precisely because he knows his shareholder base will not falter. He is not beholden to the whims of a fickle, speculative outgroup, the day traders and hedge funds that he has so effectively filtered out. The refusal to split the stock is the primary gatekeeper that maintains the purity of this in-group. A stock split would be an open invitation to the outgroup. It would flood the company with short-term players who do not share the core philosophy, diluting the culture and destabilizing the shareholder base. It would be an act of betrayal to the partners who have kept the faith for decades. By maintaining the high price, Buffett is sending a clear signal. If you are not a long-term business owner at heart, this is not the place for you. Go find a company that caters to speculators. This one is reserved for partners. To find your own management teams that share this partner-centric ethos, you need a mental model for sifting through the corporate world. We can call it the co-owner litmus test. It's a series of qualitative checks designed to reveal a management team's true attitude toward its shareholders. It moves beyond the numbers on the balance sheet to assess the character of the people running the company. The first step is to read. Go to the company's investor relations website and download the last 3 annual reports. Ignore the glossy photos and the charts for a moment and go directly to the CEO's letter to shareholders. Read it carefully. Is it written in plain, simple English, or is it filled with impenetrable corporate jargon and acronyms? Does the CEO speak candidly about the business's challenges and mistakes, or does he only highlight the successes and blame poor results on external factors? Buffett's letters are famous for their clarity and honesty. He writes as if he's speaking to a lifelong business partner, explaining what went right, what went wrong, and what he's learned. A management team that respects you as a co-owner will communicate with you in the same way. The second step is to analyze their actions. Look at their track record of corporate finance decisions over the past 5 to 10 years. Have they been serial diluters, constantly issuing new shares to fund acquisitions or executive compensation, thus reducing your ownership stake? Or have they been intelligent repurchasers of stock, buying back shares only when they trade below intrinsic value, thus increasing your stake? And, of course, have they engaged in gimmicks like frequent stock splits to generate temporary market excitement? Actions, especially in the realm of capital allocation, speak far louder than the words in an annual letter. The third step is to evaluate their engagement. How do they interact with their owners? Do they hold perfunctory quarterly earnings calls, dominated by a handful of Wall Street analysts asking short-term questions? Or do they create forums for genuine engagement with all shareholders, large and small? The Berkshire Hathaway annual meeting is the gold standard. It is an entire weekend dedicated to the shareholders, where Buffett and Munger will answer questions for hours on end from anyone who steps up to the microphone. While not every company can or should replicate this spectacle, the underlying spirit of accessibility and accountability is what you're looking for. A company that passes the co-owner litmus test is one that sees its stock as a piece of the business, not a trading vehicle. They communicate transparently, allocate capital rationally, and treat their shareholders with respect. These are the hallmarks of a management team you can partner with for the long term. A refusal to engage in stock splits is often one of the most powerful single indicators that a company will pass this test with flying colors. The path of the 99% stands in stark contrast to this partnership model. For most public companies, the shareholder base is not seen as a collection of partners, but as a fickle and often hostile audience that must be constantly appeased. The entire corporate apparatus becomes geared toward managing the expectations of this audience, specifically the powerful Wall Street analysts who can move the stock with a simple buy or sell rating. This leads to a destructive obsession with quarterly earnings. The CEO and CFO know that if they miss the analysts' consensus earnings per share estimate by even a single penny, their stock could be brutally punished. So they begin to manage the business not for long-term value creation, but for short-term earnings predictability. They might delay a crucial but costly research and development project, or cut the marketing budget, or pressure their sales team to pull deals forward from the next quarter. These actions sacrifice long-term health for the sake of a short-term cosmetic fix. It is the business equivalent of starving a thoroughbred racehorse to make weight for a minor race. In this environment, the stock split is a perfectly logical tool. When the company does have a good run and the stock price appreciates, management sees an opportunity to reward shareholders and generate positive momentum by announcing a split. It's an easy, cost-free way to create a positive news cycle and cater to the short-term psychology of the market. The 99% of investors enable and encourage this behavior. They treat the stock market like a giant casino. They buy on rumors and sell on news. They are attracted to the action that stock splits and other corporate announcements create. They don't read the annual reports. They don't think in terms of business ownership. They are renting a stock for a few days, weeks, or months, hoping to sell it to someone else at a higher price. This symbiotic relationship between short-term focused management and short-term focused investors creates a vicious cycle. The company attracts the kind of shareholders it caters to. A management team that constantly uses gimmicks will build a shareholder base of speculators. This speculative base, in turn, increases the stock's volatility and puts even more pressure on management to deliver short-term results, leading to more gimmicks. It is a treadmill of perception management, a world away from the patient, long-term business building that creates lasting wealth. Buffett's decision to opt out of this game is not just a preference, it's a strategic necessity. The kind of long-term, value-oriented investing he practices is simply impossible with a volatile, speculative shareholder base breathing down your neck. The refusal to split the stock is the foundational act of breaking this cycle. The direct financial connection between cultivating a high-quality shareholder base and superior long-term returns is not just a matter of philosophy, it is a tangible strategic advantage that shows up on the balance sheet and in the portfolio. A stable, long-term oriented shareholder base is, in effect, a source of low-cost, patient capital. Think of it as a fortress wall that protects the company's ability to make rational, long-term decisions, especially during times of crisis. The greatest investment opportunities often arise when fear grips the market, when asset prices are collapsing, and when capital is scarce. This is when Buffett, the master of contrarian investing, does his best work. The 2008 financial crisis provides the ultimate example. As the global financial system teetered on the brink of collapse, panic was everywhere. The stocks of even the strongest financial institutions were plummeting as investors, particularly short-term speculators, fled for safety. Credit markets froze. Companies that needed capital to survive found that there was none to be had. In this environment of maximum fear, Warren Buffett, armed with Berkshire Hathaway's massive cash hoard and the unwavering support of his shareholder partners, became the lender of last resort. In September 2008, he invested $5 billion in Goldman Sachs. A few weeks later, he put $3 billion into General Electric. The next year, he would provide a crucial capital injection to Bank of America. These were not just investments, they were rescue packages that came with incredibly favorable terms for Berkshire. He received not just preferred stock with high dividend yields, but also warrants that gave him the right to buy common stock at what would later prove to be absurdly low prices. These deals, which generated billions upon billions of dollars in profit for Berkshire shareholders, would have been impossible without his stable capital base. Had Berkshire been owned by a majority of short-term speculators, he would have been under immense pressure to hoard cash and avoid risk. His own stock price would have been collapsing, and he would have been forced to play defense. Instead, because his co-owners trusted him and shared his long-term perspective, he was free to go on the offensive, deploying capital with confidence when everyone else was paralyzed by fear. This patient capital advantage is a direct financial byproduct of the shareholder quality thesis. It is an asset that doesn't appear on any conventional balance sheet, but its value is immense. And the genesis of this asset, the very first step in building that fortress wall of patient partners, is the simple, powerful, and deeply contrarian refusal to cut the pizza into smaller slices. In the intricate dance between a company and the market, every action and every inaction sends a signal. A company's decision regarding stock splits is one of the clearest and most powerful signals it can send about the quality of its management and its underlying philosophy. In a world where information is imperfect and CEOs' speeches are often filled with aspirational platitudes, investors must learn to look for credible signals, actions that are costly or difficult to fake. A CEO can easily say, "We are focused on the long term," but these are just words. Refusing to split a stock that has risen to a high price, however, is a genuinely costly signal. It costs the company the fawning media attention, the temporary pop in the stock price, and the approval of Wall Street's conventional thinkers. It is an act of defiance that carries a short-term social and market cost, and precisely because it is costly, the signal is credible. It is a powerful broadcast to a specific type of investor, a beacon that says, "We are different. We do not play the short-term game. We are focused on building real business value." and we are looking for partners who understand and appreciate that mission. This signal acts as a sorting mechanism, attracting capital that is aligned with the company's philosophy and repelling capital that is not. While Berkshire Hathaway is the most famous example, this philosophy is not unique to Warren Buffett. It is a hallmark of a certain breed of rational, value-focused managers who prioritize substance over hype. Consider the case of NVR Inc., one of the largest home builders in the United States. While not a household name like Berkshire, NVR has been one of the best-performing stocks of the past 3 decades, creating astonishing wealth for its long-term shareholders. Its corporate DNA was heavily influenced by its founder, Dwight Scharre, who built the company with a relentless focus on a few key principles: disciplined capital allocation, maintaining a fortress-like balance sheet, and maximizing return on capital. Central to this ethos has been a steadfast refusal to play Wall Street's games. As NVR's business prospered and its stock price climbed, management faced the same calls that every successful company does. When are you going to split the stock? Their answer has always been a quiet, resolute never. The stock price climbed past $1,000, then $2,000, and has since traded at prices exceeding $7,000 per share. NVR's management understood that a stock split would do nothing to improve their business of building and selling homes. It would not lower the cost of lumber, it would not make land cheaper, and it would not create more qualified home buyers. It would only serve as a distraction. By refusing to split, they sent a clear signal to the investment community. The signal was that NVR was a company for serious, long-term owners, not for short-term traders. They were communicating that their scorecard was not the daily stock quote, but the multi-decade compounding of intrinsic value. If you compare the long-term stock chart of NVR to that of a rival home builder that engaged in frequent splits and more conventional corporate finance strategies, the difference is breathtaking. NVR's chart is a smooth, powerful upward march, reflecting the relentless compounding of its underlying business value. Many of its competitors' charts are jagged and volatile, marked by booms and busts. The NVR story is a powerful corroboration of the Buffett philosophy. It demonstrates that the refusal to split the stock is not some quirky eccentricity of the Oracle of Omaha. It is a key tenet of a school of management thought that is laser-focused on rational operations and intelligent capital allocation. It is the signature of a management team that has the confidence to let the business's results speak for themselves, without resorting to cosmetic gimmicks to court the market's affection. This brings us to a powerful mental model for assessing the character of a company's leadership, the gimmick-to-substance ratio. This is a framework for cutting through the noise and evaluating a management team based on the demonstrable quality of their decisions. It's a way to turn a qualitative assessment of management quality into something more tangible and systematic. The process begins with a bit of detective work. You must review a company's public communications, press releases, investor presentations, and annual reports over the last 5 years. As you read, you will keep 2 separate tallies. The first tally is for gimmicks. A gimmick is any corporate action or announcement whose primary purpose is to influence the stock price or market perception rather than to improve the underlying business. This includes stock splits, splashy corporate rebranding efforts that aren't tied to a fundamental business shift, overly promotional press releases for minor product updates, and the use of fuzzy, non-standard accounting metrics to paint a rosier picture of performance. You assign 1 point to each instance of a gimmick. The second tally is for substance. A substantive action is one that directly enhances the long-term earning power or resilience of the business. This includes a demonstrably smart acquisition that creates real synergies, the strategic sale of a non-core division, a significant and successful investment in research and development, a disciplined share repurchase program executed at prices below intrinsic value, or the candid and transparent discussion of a business failure and the lessons learned from it. Each substantive action also gets 1 point. After reviewing the 5-year history, you calculate the ratio. Divide the total gimmick points by the total substance points. A high gimmick-to-substance ratio is a massive red flag. It indicates a management team that is more focused on playing the market's game than on running the business. Their attention, and therefore the company's resources, are being diverted to activities that create no lasting value. Conversely, a company with a very low ratio, ideally close to zero, is a company run by operators. These are managers who are focused on the levers they can control: product quality, customer service, operational efficiency, and intelligent capital allocation. A company like Berkshire Hathaway or NVR would have a gimmick-to-substance ratio of virtually zero. They almost never engage in actions designed to manipulate market perception. Their public communications are straightforward, business-focused, and devoid of hype. This mental model provides a powerful filter. Before you invest your hard-earned capital, you can use this ratio to quickly assess whether you are dealing with promoters or with partners. The refusal to split the stock is one of the strongest possible indicators that you have found the latter. The path of the 99% of corporate leaders is dictated by a different set of incentives and pressures. Most CEOs are not long-term owner-operators like Buffett. They are professional managers, often with a tenure of only a few years, whose compensation is heavily tied to the company's stock performance during that short period. They operate in a world dominated by the quarterly earnings cycle and the relentless scrutiny of Wall Street. Their primary audience is not the patient, individual investor, but the institutional analyst who holds the power to upgrade or downgrade their stock. In this context, the stock split is not a gimmick. It's a standard tool in the corporate finance toolkit. The logic is conventional and deeply ingrained. A high stock price is seen as a barrier to entry for retail investors. A split improves trading liquidity by increasing the number of shares and lowering the price, which makes it easier for large institutions to build or exit positions without moving the price significantly. The announcement of a split is viewed as a signal of management's confidence in the company's future prospects. These are the arguments that are taught in business schools and repeated by investment bankers. The CEO who follows this path is simply doing what is expected of them. They are following the established script for a successful public company. To deviate from this script, to refuse to split the stock, would be seen as eccentric, arrogant, or even shareholder-unfriendly. It would require explaining to their board and to Wall Street why they are deliberately choosing to make their stock less accessible. It is far easier and far safer for their career to simply go along with the convention. This creates a culture where perception is often prioritized over reality. The focus shifts from the hard internal work of building a better business to the easier external work of managing the stock price. The annual strategic plan can become less about gaining market share and more about hitting the quarterly numbers that will keep the stock price buoyant. The stock split is a perfect symbol of this mindset. It is an action that produces a visible, positive, short-term market reaction, while having absolutely no impact on the underlying business. It is the corporate equivalent of empty calories. It feels good in the moment, but provides no long-term nourishment. This is the path of conformity, of following the crowd, and of prioritizing the fleeting judgment of the market over the enduring logic of business value. The direct financial connection between a management team's philosophy on stock splits and their effectiveness as capital allocators is profound. Capital allocation is the single most important job of a CEO. It is the process of deciding how to deploy the company's profits, reinvest in the core business, acquire other companies, pay down debt, or return cash to shareholders through dividends or buybacks. The decisions made in this process have a far greater impact on long-term shareholder returns than any other aspect of the business. A management team that spends its time and energy debating and executing a stock split is, by definition, a management team whose focus is diluted. Their attention is being drawn away from the critical questions of capital allocation and toward the trivial matter of share price aesthetics. This seemingly small lapse in focus is often a symptom of a deeper problem. It suggests a management culture that is more concerned with the stock ticker than with the business's return on invested capital, ROIC, which is the ultimate measure of a company's financial performance. Let's quantify the difference. Imagine two companies, Company A and Company B, each generating $1 billion in profit. The management of Company A, which has a high gimmick-to-substance ratio, spends its time courting Wall Street and announces a 2-for-1 stock split to great fanfare. The management of Company B, which has a ratio of 0, ignores the stock market and focuses all its energy on finding ways to improve its operations and intelligently reinvest its profits. Through their relentless focus, they manage to increase their company's return on invested capital by just 1 percentage point more than Company A each year. At first, the difference is barely noticeable. But over a decade, the power of compounding takes hold. That small 1% edge in capital allocation efficiency results in Company B being significantly larger, more profitable, and more valuable than Company A. The stock split enjoyed by Company A shareholders is a distant, forgotten memory, completely overwhelmed by the massive creation of intrinsic value at Company B. The refusal to split the stock is a powerful proxy for a disciplined and rational approach to capital allocation. It signals a management team that understands that their job is not to manage the stock price, but to manage the business. They know that if they do the latter exceptionally well, the stock price will, over the long run, take care of itself. This is the ultimate financial connection. A simple decision about corporate finance mechanics reveals a deep truth about a management team's priorities, and those priorities are the ultimate driver of your long-term investment returns. The allure of the stock split is not just a corporate phenomenon. It is deeply rooted in the predictable irrationality of the human mind. To truly become immune to its siren song, we must dissect the specific cognitive biases it exploits. The dot-com bubble of the late 1990s serves as a perfect laboratory for this psychological exploration. It was a time of mass delusion, where the psychology of the crowd completely overwhelmed the logic of valuation. Companies with little more than a business plan and a .com in their name achieved market capitalizations in the billions of dollars. And the stock split was a key piece of machinery in this engine of hype. Take, for example, a company like Webvan. Its plan was audacious: to build a nationwide network of warehouses and delivery trucks to bring groceries directly to people's homes. It was a compelling vision that captured the public's imagination. Webvan went public in 1999, and its stock soared on the first day of trading. As the price climbed, the company quickly did what all bubble-era darlings did. It announced a stock split. This kept the nominal price of the stock in a buyable range for the legions of new day traders who were entering the market, drawn by stories of easy money. They saw a post-split price of, say, $25, and it felt infinitely more accessible and full of potential than a pre-split price of $50. They were not analyzing Webvan's colossal cash burn rate, its logistical nightmares, or the razor-thin margins of the grocery industry. They were reacting to a number on a screen. The split acted as fuel on the fire, creating a fresh wave of enthusiasm and drawing in more amateur investors who felt they were getting in on the ground floor of the future. The psychology was intoxicating. Each split was seen as confirmation that the company was succeeding, which drove the price higher, which in turn justified the next split. It was a self-reinforcing feedback loop of pure speculation. The tragic end of the story is well known. Webvan burned through nearly $1 billion in capital in just a couple of years and went bankrupt in 2001, wiping out its shareholders completely. The investors who were lured in by the cheap stock prices created by the splits were left with nothing. Their experience is a brutal lesson in the dangers of confusing a low nominal price with a good value. The stock split didn't make the business any more viable. It simply made a bad bet look more affordable. It was a psychological tool used, intentionally or not, to distribute a massively overvalued and fundamentally flawed business to the general public, with catastrophic results for those who fell for the trick. This catastrophic failure of judgment can be explained by a trio of powerful cognitive biases that a stock split activates in our brains. The first, and perhaps most subtle, is the anchoring bias. Our brains have a tendency to rely too heavily on the first piece of information offered when making decisions. When a stock splits, The new, lower price becomes a powerful anchor. An investor who saw a stock trading at $400 now sees it at $100 after a 4-for-1 split. Their brain latches onto that $100 price as the new baseline. They may subconsciously think, it used to be $400, so at $100 it's a bargain. It has so much room to run back up. They fail to properly adjust their anchor for the fact that the number of shares has quadrupled. The valuation of the company is the same, but their perception of its potential is skewed by the new, lower anchor point. The second bias, as we've discussed, is the unit bias, our innate preference for whole units. The psychological satisfaction of being able to purchase a round lot of 100 shares at $10 feels greater than purchasing a single share at $1,000. It creates an illusion of control and substance. We feel like a more significant investor with our 100 shares, even though our financial stake is identical. This taps into our brain's desire for quantity, a heuristic that serves us well when gathering food but fails us completely when assessing ownership in a business. The third and most dangerous bias is herding, also known as social proof. We are social creatures, and we have a deep-seated instinct to follow the crowd. When a company announces a stock split and the financial media celebrates it, and we see the stock price jump as others pile in, it creates an overwhelming sense of social proof. The internal monologue is, everyone else thinks this is a good idea, so it must be. I don't want to be left behind. This instinct to herd can shut down our rational, analytical mind. The fear of missing out, or FOMO, becomes a more powerful motivator than a sober assessment of the business's intrinsic value. A stock split is the perfect trigger for this herd behavior. It is a highly visible, widely publicized event that creates a clear focal point for speculative frenzy. Buffett's entire investment career has been a testament to the power of resisting this herding instinct. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." His refusal to split the stock is a structural mechanism to short-circuit these biases. It makes it harder to anchor on a cheap price, it denies the psychological satisfaction of owning many units, and it signals a deliberate separation from the speculative herd. To systematically override these powerful and deeply ingrained biases, we need an unemotional, logic-driven process. We need a valuation-first framework. This is a mental model that acts as a firebreak, stopping the emotional reaction to a split announcement before it can hijack our decision-making process. It consists of 4 simple but rigid steps. Step 1. The moment you hear of a split, you must immediately and consciously ignore the new, post-split share price. Treat it as irrelevant, toxic data. It is a number designed specifically to trigger your biases. Acknowledge its existence, and then mentally discard it. Step 2. Find the company's total market capitalization on the day before the split was announced. This number, the total value of the entire enterprise, is your new anchor. It is the only price that matters. Write it down. Stare at it. This represents what the market thought the entire business was worth before the cosmetic change. Step 3. Now, do the work of a business analyst. Completely ignore the stock market for a moment and focus on the business itself. Pull up its financial statements. Analyze its revenue growth, profit margins, debt levels, and return on equity. Reread your original investment thesis. What is this business, this entire economic engine, fundamentally worth to you as a private owner? This is the most difficult but most important step. You must arrive at your own independent estimate of the company's intrinsic value. Step 4. Compare your estimate of the business's intrinsic value from Step 3 with the market capitalization you wrote down from Step 2. This comparison and this comparison alone should be the basis of your decision. If you believe the business is worth significantly more than its pre-split market cap, it might be a buy. If you believe it's worth significantly less, it's a sell. The share price, whether it's $5 or $500, is utterly irrelevant to this final, rational decision. By rigidly following this framework, you force a shift in your perspective. You move from being a price watcher reacting to the superficial noise of the market, to being a business valuator, making decisions based on the underlying economic reality. It is a disciplined practice that starves your cognitive biases of the emotional fuel they need to operate, allowing your rational mind to remain in control. The path of the 99% is the polar opposite of this disciplined framework. It is a path of pure emotion and reaction. The process, for the typical retail investor, looks something like this. They are watching a financial news channel or scrolling through a finance website. A breaking news alert flashes across the screen. Tech giant XYZ announces 10-for-1 stock split. The anchor on the news channel speaks with excitement. This is a great move, really making the stock more accessible to the little guy. The stock is soaring in after-hours trading on the news. The investor's heart beats a little faster. The fear of missing out kicks in. They think, wow, XYZ is a great company. I always wanted to own it, but it was too expensive at $1.200 a share. Now, after the split, it will be only $120. That's so much more affordable, I have to get in. They log into their brokerage account and place a buy order. At no point in this process is there any valuation work. There is no analysis of the balance sheet, no calculation of intrinsic value, no consideration of the market capitalization. The entire decision is driven by three factors: the media hype, the social proof of the rising price, and the powerful psychological allure of the new, lower nominal price. They are not buying a piece of a business, they are buying a popular ticker symbol. They are reacting to the unit price, not analyzing the value of the enterprise. This is the essence of speculative trading psychology. It is an emotional response to market stimuli, and it is a game that is almost impossible for the individual investor to win over the long term. They are perpetually late to the party, buying into the hype that has been manufactured by corporate communications departments and amplified by the media. The stock split is one of the most effective tools ever devised for triggering this exact chain of irrational, emotional, and ultimately, wealth-destroying behavior. The financial cost of succumbing to this psychological pull can be quantified. Let's create a simple scenario to illustrate the hype premium paid by those who react to the split. Consider a solid, growing company, Quality Corp, with a stock price of $300. Investor A, a disciplined value investor, has analyzed the business using the valuation-first framework. She determines that the intrinsic value of the business is approximately $310 per share. Seeing a small margin of safety, she buys the stock at $300. A week later, Quality Corp, following convention, announces a 3-for-1 stock split. The news generates significant excitement. The stock, which would have reset to $100, instead gets a hype bump and begins trading at $105 as speculators and retail investors pile in. Investor B, who follows the path of the 99%, sees this excitement. He thinks, it's only $105 and it used to be $300. What a deal! He buys the stock at $105. Both investors now own a piece of the same company, but Investor A bought at a price that reflected the business's pre-hype valuation. Investor B paid a 5% premium for the excitement and the affordability created by the split. Now, let's say the next quarter, Quality Corp reports earnings that are good, but not spectacular. They meet expectations but don't blow them away. The hype from the stock split has faded. The speculators move on to the next hot story. The stock price drifts back down to a level that reflects its fundamental value, which is now around $103 per share. The original $310 value divided by 3. Where do our two investors stand? Investor A is still up slightly on her position. Her purchase was based on value, so she is insulated from the evaporation of the hype. Investor B, however, is now underwater. The 5% premium he paid has vanished into thin air. He is now more likely to panic and sell at a loss, blaming the, quote, manipulated market. In reality, his loss was self-inflicted. It was the direct, quantifiable financial cost of making a decision based on the psychological lure of a stock split rather than on a sober analysis of the underlying business. Multiply this small loss across millions of investors and thousands of stock splits, and you begin to understand the sheer scale of the value destruction caused by this seemingly harmless corporate action. There is no greater physical manifestation of this entire philosophy, no more powerful testament to the long-term rewards of rejecting Wall Street's gimmicks than the stock price of Berkshire Hathaway's Class A shares. It is a living, breathing monument to the principles of long-term investing, shareholder partnership, and the relentless focus on intrinsic value. The story of this stock price is the story of Warren Buffett's career, and it serves as the final, unassailable proof of his argument. The journey begins in 1965. Warren Buffett, then a young but already successful private fund manager, took control of a struggling New England textile manufacturer called Berkshire Hathaway. The stock was trading for around $15 per share. The business itself was doomed, a relic of a dying industry. But Buffett saw that it had cash on its books, and he began to use that cash as a platform to buy other, better businesses. He was not interested in the textile operations. He was interested in Berkshire as a corporate vehicle for his capital allocation strategy. As he made a series of brilliant investments, buying wonderful businesses like See's Candies and the Buffalo Evening News at fair prices, the intrinsic value of Berkshire Hathaway began to grow, and its stock price followed. It crossed $100. Then, in the early 1980s, it crossed an important psychological barrier, $1,000 per share. The questions began immediately. At the annual meetings, shareholders would step up to the microphone and ask, "Warren, the stock is getting expensive. When are you going to split it to make it more accessible?" His answer was always polite, patient, and unwavering. He would explain the pizza slice analogy. He would talk about wanting to attract long-term partners, not short-term speculators. He would say that he didn't want the stock to be traded like a poker chip. The business continued to grow, and so did the stock price. In 1992, it crossed $10,000. The calls for a split grew louder. Wall Street pundits called him arrogant, out of touch. They said he was hurting liquidity and preventing small investors from participating in his success. Buffett held firm. His letters to shareholders during this period repeatedly reinforced his philosophy. He was educating his partners, steeling them against the conventional wisdom, and explaining over and over why the quality of the shareholder base was more important than the quantity. Then, in 2006, the impossible happened. Berkshire Hathaway Class A stock crossed $100,000 per share. It was a landmark moment, a six-figure stock price that seemed to belong to another planet. It became a symbol of his entire approach, a defiant rejection of every short-term trick in the corporate finance playbook. The price continued its relentless climb, driven by the ever-increasing earning power of its vast collection of subsidiary businesses. It crossed $200,000, then $300,000, and in recent years has traded at levels exceeding $500,000 for a single share. Each new milestone was a fresh vindication of his 50-year-old decision. He had proven, beyond any shadow of a doubt, that a company could not only survive but thrive spectacularly without ever catering to the speculative whims of the market. The price itself became the ultimate signal, the ultimate filter, and the ultimate reward for the partners who had kept the faith. The psychological principle that underpins this remarkable multi-decade journey is that of commitment and consistency. Humans have a deep psychological need to be consistent with their past decisions and public statements. Once we have made a stand or committed to a belief, we face internal and external pressure to behave consistently with that commitment. Warren Buffett established his no-split policy early in his tenure at Berkshire. He stated his reasoning clearly and publicly. With each passing year, with each shareholder meeting where he reiterated his stance, his commitment deepened. He was building a powerful psychological contract with his shareholders. The message was clear: this is who we are. These are our principles. They will not change. This unwavering consistency creates an incredible amount of trust. In a financial world filled with shifting strategies, management turnover, and a constant search for the next fad, Berkshire Hathaway became an island of stability. Shareholders knew that the rules of the game would not be changed on them. This trust is the glue that holds the entire partnership together. Furthermore, this consistency creates a powerful self-reinforcing loop. By stating his philosophy and sticking to it, Buffett attracted a certain type of investor, those who were naturally inclined to think long-term and focus on business value. This high-quality shareholder base, in turn, gave him the freedom and stability to make the rational, long-term capital allocation decisions that drove the company's success. The success of those decisions led to a higher stock price, which only served to further vindicate the original no-split policy, strengthening his resolve and attracting even more like-minded partners. It is a virtuous cycle of philosophy, partnership, and performance. The high stock price is not merely a result of this cycle, it is an active component of it. It is the public scoreboard of his commitment. Every day that BRKA trades at a six-figure price, it is a reminder to the world of the power of a consistent, long-term philosophy. It is a monument to the idea that if you build a great business and partner with the right people, you never have to play the games that lesser companies feel they must. To internalize this lesson and apply it to your own investment practice requires a fundamental shift in your time horizon. The mental model for this is the multi-decade scorecard. It is a framework for emulating the perspective that created the Berkshire Hathaway phenomenon. The first step is to change how you begin your investment journey. When you purchase a stock, you are not just buying a ticker. You are hiring a management team to be your partners in a business venture. On the day you buy, take out a piece of paper or open a document and write down your partnership thesis. Clearly articulate why you are buying this business. What is its competitive advantage? Why do you believe its earning power will grow over the next 10 to 20 years? What are the key business metrics, not stock price targets, that you will use to judge management's performance? Step 2 is the hardest. Put it away. You must consciously resist the urge to check the stock price every day, or even every week. This daily noise is the enemy of long-term thinking. It triggers emotional responses and tempts you to trade based on meaningless fluctuations. Commit to checking in on your businesses, not your stocks, perhaps once or twice a year. Step 3 is the evaluation. Every few years, pull out your original partnership thesis and compare it to the company's actual business results. Has management executed on the strategy they laid out? Have revenues, earnings, and free cash flow grown as you anticipated? Has the company strengthened its competitive moat? Notice that none of these questions are about the stock price. You are evaluating the performance of your partners in running the business. The stock price of Berkshire Hathaway is the ultimate example of a multi-decade scorecard. People who bought in the 60s, 70s, or 80s and simply held on, trusting their partner Warren Buffett to manage the business, have seen their scorecard produce results that are almost beyond belief. This model forces you to adopt the same mindset. It transforms you from a stock renter, nervously watching the quote screen, into a business owner, patiently judging your management partners by the only metric that matters, their ability to increase the long-term intrinsic value of the enterprise. The path of the 99% is a world away from this patient, multi-decade perspective. The average investor is obsessed with the short term. They are searching for the next 10-bagger that will happen in the next year, not the next decade. Their time horizon is measured in months, not generations. From this perspective, a stock like Berkshire Hathaway Class A is completely uninvestable. First, there is the barrier of the high price. They cannot afford a full share, and the idea of saving for years to buy one seems absurd when there are thousands of cheaper stocks to trade. Second, they perceive it as a slow-moving dinosaur. It doesn't offer the thrilling volatility and the promise of quick riches that a hot tech stock or a speculative biotech company does. They are looking for action, for excitement, for a story they can tell their friends about next week. They are playing the game of chasing price movements, a game that is mathematically stacked against them. After commissions and taxes, active trading is a negative-sum game. For every winner, there must be a loser, and the house always takes its cut. What they fail to comprehend is the almost magical power of long-term compounding, a power that is only accessible through the very patience they lack. They cannot see that the boring act of owning a great business run by great people for a very long time is the most reliable path to extraordinary wealth ever discovered. The high unsplit price of Berkshire Hathaway stock acts as a philosophical wall, separating these two worlds. It stands as a silent rebuke to the short-term, speculative mindset of the 99%. It is a statement that the game of true wealth creation is played on a different field, with a different set of rules and a different scorecard. Those who understand this can join the partnership. Those who don't are free to continue chasing the fleeting excitement of the casino, a game that almost all of them are destined to lose. And now, we arrive at the final, direct financial connection. The ultimate argument against the stock split and for the Buffett philosophy is written in the language of numbers, in the stark, undeniable mathematics of compound interest. Since Warren Buffett took control in 1965, Berkshire Hathaway's stock has delivered a compound annual growth rate of approximately 20%. The S&P 500, a benchmark for the market as a whole, has returned about 10% annually over that same period, including dividends. This 1% difference per year might seem small to the uninitiated, but over a span of more than half a century, its effect is not just large, it is world-altering. Let's translate this into real dollars. A $1,000 investment in a simple S&P 500 index fund in 1965 would be worth around $230,000 today. That is a fantastic return, a testament to the power of owning a piece of American business. But what would a $1,000 investment in Berkshire Hathaway back in 1965 be worth today? That same $1,000, compounding at 20% per year, would have grown to be worth over $27 million. The difference is not a matter of degree, it is a matter of category. It is the difference between a comfortable retirement and generational wealth. This colossal outperformance is the final verdict. And it is crucial to understand that this success was achieved not in spite of the no-split policy, but in many ways because of it. The refusal to split the stock was the foundational decision that allowed Buffett to build the shareholder base he needed. That shareholder base provided him with the stable, patient capital required to execute his brilliant, long-term contrarian investment strategy. That strategy, in turn, generated the incredible returns that are reflected in the stock's astronomical price. The entire structure is a single, interwoven tapestry. The high stock price is not a quirky byproduct of the success. It is a core component of the machine that generated it. It stands today as the most expensive stock in the world, a $500,000 pizza slice that serves as irrefutable, mathematical proof that focusing on business fundamentals, cultivating a partnership with your shareholders, and completely ignoring the short-term games of Wall Street is the most powerful financial strategy on earth. You have just invested a significant amount of your time and attention, and in doing so, you have acquired a powerful new lens through which to view the entire world of investing. You now possess the mental toolkit to distinguish between the financial engineering that creates fleeting excitement and the genuine business building that creates lasting value. You can see through the hype of a stock split and recognize it for what it is: a sideshow, a distraction, a piece of market noise designed to appeal to our most basic cognitive biases. This ability to separate signal from noise is not a small thing. It is a fundamental dividing line between the amateur investor, who is perpetually tossed about by the whims of the market, and the professional-minded business owner who remains steadfast, focused on the underlying reality. But it is crucial to understand that this principle, this deep insight into shareholder quality and management signaling, is not an isolated piece of wisdom. It is a single, critical node in a much larger, interconnected network of mental models that form the complete Buffett-Munger philosophy. The idea of cultivating the right partners is deeply connected to the concept of a circle of competence, the discipline of only investing in businesses you truly understand. It is linked to the search for companies with durable competitive advantages, or moats, because only great businesses are worthy of such long-term partnerships. And it is all built upon the bedrock principle of margin of safety, the discipline of buying those great businesses only at prices that offer a significant discount to their intrinsic value. Each of these concepts supports and reinforces the others, creating a powerful latticework of rational thought that, when applied consistently, becomes an almost unstoppable force for wealth creation. That video that is appearing on your screen right now is not a random suggestion from an algorithm. In the grand map of this intellectual journey, it is the next connecting piece. It might be the video that explores how to identify a durable moat in the 21st century. It might be the one that deconstructs the psychological discipline required to act with a margin of safety when markets are in turmoil. It is the link that connects what you have just mastered about the character of a business to the quantitative analysis of its value. It is the next step in assembling the complete system, in turning a single powerful insight into a comprehensive and resilient investment philosophy. This brings you to a decision. There are two types of people who seek out financial knowledge. There are those who collect tips and tricks, looking for the next hot stock or the secret to timing the market. They accumulate scattered pieces of information. Then there are those who build an arsenal. They understand that true, lasting success comes from constructing a coherent and robust set of mental tools, a complete framework for thinking that allows them to navigate any market environment with clarity and confidence. The click you are about to make is not just about watching another video. It is a declaration of which type of person you are choosing to become. It is a choice to continue your ascent, to add the next weapon to your cognitive toolkit, and to complete the intellectual arsenal required to secure your financial future. The journey continues.